Hey, welcome back to The Dive. Today on the show, we have the president and CEO of Solaris Resources, Daniel Earle. He's here today to share with us some challenges the mining sector faces due to inflation, his stance on the recessionary debate, where he sees the copper and gold price heading next, and he's going to give us a company update on Solaris. Hey, Daniel, welcome back to The Dive.
Thank you. Pleased to be here.
Yeah, thank you so much for joining us, Daniel. Now, according to Goldman Sachs, there is a 35% chance of a recession in the next 12 months. Where do you sit with the recessionary debate, and how big of a challenge is inflation and recessionary talks in the mining sector?
Yeah, so I think basically what we're talking about is a second recession. So if you recall, in the first quarter, you had a contraction of about 1.5% in GDP, and then followed that with about a 0.6% decline in the second quarter. So that was right there, a technical recession before the rebound in Q3. Even if the National Bureau of Economic Research didn't call it as such, that was the situation. And I think the basic difficulty right now for the Fed, because this is going to be driven by Fed action here, is that you've got inflation still very high, and then unemployment very low. And obviously they've got a dual mandate on both of those counts to ensure price stability at the same time as maximum employment. And they're very much focused on the former, and they're trying to bring down aggregate demand to essentially ease the latter and bring these two into balance. Okay, and inflation is of course a lagging indicator. We've got a lot of tightening that's already in the pipeline in terms of delivering those effects, and going to take time to show up. But I think it's pretty clear at this stage that you've really got a lot of signs that inflation is going to materially decelerate, like really quite sharply come down next year. And the market is beginning to price this in. So basically, as long as the Fed doesn't continue hiking rates to the point that it brings into question, kind of financial stability, then, or in other words, basically follows the market outlook, then I don't really see potential for a real economic crisis to develop. And so this would be your basic, soft landing scenario. Even if we have a recession, a pretty mild and short-lived recession next year. And then obviously the situation in Europe is worse because of the overlay of the energy crisis. In China, I'd have a more optimistic view because the government now, post People's Party Congress, is really taking action at addressing the two issues there, which are around the property crisis and then zero COVID, where even if we're seeing a flare up at the moment in COVID cases, I think policymakers understand that they're going to have to relax their zero COVID policies to have less of a restrictive effect in terms of economic activity. And so if you think about the mining sector in a recession, especially for the industrial metals, you're going to see some significant impact. Typically in a recession, we'd have about a 15% decline in revenues and about a 40% decline in EBITDA. I think the market has already priced this in. We saw a 30% correction in the copper price without the fundamentals really deteriorating, a 50 to 60% correction in the largest cap copper producers in terms of equities. So I'd say we've done the majority of the work already to kind of prepare for this. I wouldn't expect any further major deterioration if everything plays out the way that I just suggested it may.
Now, India's top mining industry federation is seeking higher import taxes on metals such as zinc, aluminum, and copper. What are your thoughts on this?
Yeah, so I think this basically reflects the shift in India that we've seen in the copper market from them being a net exporter to being a net importer, and that happened in the last 5 years in that country. But in terms of the total scale of the demand, it's almost an afterthought. We tend to focus in the copper industry on China, which is about 50% of overall demand, rather than India. India would be about kind of 1 million to 1.5 million tons per annum of demand. Okay, so it's not that significant at present. Really, the more interesting thing with India is the growth in demand. So this is almost like, in terms of their economy, the size of the economy is kind of where China was 15 years ago. And similar to China, you've got the same kind of dynamics that are driving a really, an outlook for rapid growth rate, where you've got, strong overall economic growth, but then within that, You've got a push towards urbanization. You've got, a strong push in terms of developing basic infrastructure in the country, which is all incredibly copper intensive. And then in addition, you've got this this kind of horrific pollution, which is driving and pushing also for geopolitical reasons them away from fossil fuels towards electrification. So you've got this kind of energy transition, which, as we know in other jurisdictions, incredibly copper intensive. It's really driving rapid demand growth, or will drive rapid demand growth, across this decade and beyond in terms of copper consumption. So if you look at the statistics, even if India isn't all that significant right now, around 1 million tons, they're expected to triple their copper demand by the end of this decade, out to something of the order of 3 million tons. And that's when you're starting to talk about, really material levels of copper demand in India. So it's a very positive outlook for the country.
Given the macro backdrop, what is your read on where the price of copper is heading next?
I think first of all, the market has already done a lot of work in taking down and insulating the copper price against a further economic slowdown. So, we've seen the copper price across Q2 and then into Q3 come down basically 30% without the fundamentals materially deteriorating. We're still in a very tight position. Both in Shanghai, we've got about 2 days of copper supply, and then in the LME, not much more than that. Because of the way that supply has come down alongside demand, still a fundamentally very tight situation, and yet the prices have corrected significantly. So I think the work has been done. I'm not expecting, in a soft landing scenario in the US, worse than that in Europe, a bit of a recovery next year in China. I'm not expecting that in that kind of an economic backdrop, you would have copper prices significantly lower than where they are today. So in other words, I would be projecting sort of a flat copper price environment around the 350 price level for next year.
We see a lot of investor decks for copper juniors and exploration plays. From your view, how much sense do early stage copper plays make for risk capital?
We've still got an incredibly tight market in terms of the fundamentals for copper. Even if the economic picture is kind of worsening, I think the market is kind of priced in the worst, and if anything, things are relaxing a little bit. So you've got, if you want to capture all of that in sort of the outlook for the copper price, you would see that we're kind of seeing a stable copper price, in and around these levels, around 350 a pound. Okay, so in a stable price environment, when you're looking at the copper equities, and particularly like the exploration companies, what's going to drive returns there is the success of those exploration plays. And what's unique about copper is that for the copper industry, you're really looking in particular for world-class projects. So small copper projects, even if they're robust in terms of their economics, like they're high grade and what have you, they tend to not get a lot of reception in the copper industry. So these projects tend to have to be developed by the proponent of the project to really get them into production. Whereas if you focus on world-class projects in copper, then you have exposure to acquisitions by the major producers who are short these projects structurally. They have depleted pipelines almost across the board and need to acquire these projects to add to their production profiles, particularly for the back half of the decade when we're forecasting these really acute deficits. So I think copper is a bit unique in that sense from more traditional sectors for investors like gold, let's say, a huge sector for exploration investment in Canada and the United States. In copper, you've got to be a bit more selective, I believe.
What about gold? What are you seeing for gold next?
Well, gold's much more difficult to call than copper. I think precious metals generally are more difficult than industrial metals. Gold being the hardest, the purest of the kind of the precious metals. Silver easier, and then PGM's easier than that still. But when you look at gold, like across its history, the correlations vary quite dramatically from one market to a given market. So you could have the US dollar generally being correlated to the inverse of the US dollar, but then for some periods it actually correlates positively. The best correlation I would say is to the inverse of 10-year real rates. And of course, real rates currently are at unusually high levels. We had a very long run trend in place, like a multi-decade trend of declining real rates going back to, the late 70s, the early 80s. And then recently with this inflation impulse and then rates, going at least march up in rate, really rapid march up in rates, an unusually aggressive hiking cycle, we've got real rates that are sitting at nearly 2%. And so that's kind of an outlier when you look at the long run trend. You would say that real rates are likely to decline from these levels, even if we're in a new, we've undergone a paradigm shift to now a new, higher inflation environment. You'd still say that real rates were likely to come down. I think if real rates come down, you probably got an environment where the dollar is coming down along with it. And I think this would broadly be supportive for gold. So I think you can make the case over the medium term that gold, even the short term, that gold should be, performing well. But obviously with the caveat that calling gold is just a very, fundamentally just a very difficult proposition.
Between gold and copper, where do you see the most opportunity in 2023?
Yeah, like in terms of the metals, it's like I just laid out. It's I think probably easier to make a case that the gold price has an opportunity for more upside relative to copper. The outlook for copper is that we'll essentially have sideways trading action. But I think when it comes to the equities, it's a different question. And so in the equities, you've got this disconnect where we've seen a sharp correction in copper equities, even if the fundamentals remain extremely tight. And so that sets up, the opportunity for a significant rebound. And I think as the M&A cycle continues to intensify and begins to focus more on these, pre-production stage copper equities, then I think that's the kind of environment where you can have really strong returns in that space. Whereas in gold, I think M&A is likely to continue to be muted because of the limited cash generation and the balance sheets that you have on the part of the potential acquirers in that space. So I guess that's a bit of a nuanced answer. I like copper equities more than I like gold equities for this year, even if the outlook, you can make a case for a higher gold price, I think, than you can copper.
Okay, now let's move on and talk about Solaris. You announced assay results from a series of holes at the Warinzta Project in southeastern Ecuador. Can you walk us through the results and maybe tell us about how they could impact the exploration strategy?
Yeah, absolutely. So if you recall with Solaris, all the drilling up to the end of last year was in support of a resource estimate that we published in April of this year. And so that resource was 1.5 billion tons, circa 0.5% copper in an open pit. And then within that, a high-grade starter pit, which really drives robust economics for this project, which was 287 million tons, circa 0.8% copper equivalent, right at surface, available for mining in the early years of the mine life. And then basically what we focused on the drilling program this year is a goal of doubling the size of that starter pit. And so here what we've done is we've come back to some of the highest grade drilling that we completed at Warintza Central. Was right at the end of the drill program, right on the northeastern edge of the drill grid and the resource at the time. And we've come in there and we've added hundreds of meters of strike length to what we're calling the Northeast Extension Zone. And this goes towards our goal of doubling the size of that starter pit out to over 500 million tons when we complete this program. And then in respect to the overall resource, we're going back to the Warintza East deposit. Okay, so the vast majority of the drilling in that resource was in the central deposit. Towards the end of the program, we discovered the East deposit. It only got a few holes into it, but going back to that East deposit and then filling in what is a footprint of a very large porphyry deposit there with drilling to bring that to a resource category. And so that'll drive very material growth in the overall size of the resource here. Okay, so that's the resource growth drilling program. That's, I think, the focus of the market. In addition to that, we've got two other discoveries. one at Warintza West and one at Warintza South. These were both discovered on the very first holes that we drilled into these targets. Warintza West early 2021, and then South early 2022. And at West, we've gone back in here and we've drilled from the site of that discovery hole all the way around the clock. And we've still got a few more holes coming from that program, but drilling all the way around the clock to show people that it's literally mineralized in every single direction and still open. And so there's therefore potential for a large scale resource at Warintza West in the future. It's not part of the current resource drilling program. It will require more drilling, but just to demonstrate the potential for that. And then at the South deposit, this is the largest target that we have within the Warintza cluster of 4 deposits. This is the largest target. It's like 2.5 kilometers on the long axis by about 2 kilometers on the short axis. The discovery drill hole early this year was at the far south end of that deposit. And we've come back in with a sampling program of over 1,000 rock chip samples that we've taken, comprehensive mapping of the alteration and so on, to figure out the architecture of that large deposit. And now in our presentation, if you check it out, you can see we're showing the results of that sampling. There's one area in particular, about 1.5 kilometers to the north of the discovery drill hole, still within this same deposit, where we've got much higher grade mineralization right at surface. And this mineralization would be similar to what we see at the central deposit. So high grade supergene mineralization and also high grade hypogene or primary mineralization like we haven't seen before on this Warintza project. So that's a very exciting target for discovery drilling, or kind of a new discovery of a potential second starter pit, which is set up to take place early next year. And that could be an absolute game changer in terms of the view of this overall Warintza project if we were to be successful in that drilling early next year.
For investors who are watching the story, is there anything else that they should be looking out for in terms of timelines?
Yeah, absolutely. I think even just outside of the drill results that will be coming on a regular basis, we'll have drill results both from the drilling at East, more results from the extension of the starter pit at Central, West, and then all of that this year. And then the drilling from South is very important, drilling early next year. But even beyond the drill results, we continue to make progress in terms of Ecuador and de-risking the story. The next key catalyst there will be what's called an investment protection agreement. And here what we're looking to do is basically freeze in place the tax regime. This is one of the lowest effective tax rates in all of South America, to freeze that in place, and at the same time freeze in place the mining legislation, so the mining law governing this project. So it's like a tax stability and a mining law stability all in this one investment protection agreement. So look out for that in the coming weeks. That's a key part of the de-risking of the story. But I think even outside of these, these catalysts with the exploration and then with our government program, I think one of the main factors is just going to be getting through this calendar year. We had a lot of warrants come due in November and December. That put a lot of pressure on our share price. It overlaps, of course, when you have this bear market tape, it overlaps with book clearing that takes place around this time of year and tax loss selling, and produces a lot of pressure on a stock. So we're just coming through that now. I think you can already start to see some relief in our share price. And I think that this on its own will be very significant in terms of taking the stock higher just in the coming month or so.
Okay, great. Well, thank you so much for coming on, Daniel, and giving us the update.
Thanks so much for having me. Pleasure to be here.
Thanks so much for watching today. We'll be back again tomorrow with the latest news and updates. So be sure to stay tuned by hitting that notification bell and subscribing below. Bye.